Everybody, in today's video, we are going to be covering one of the principles of investing, and that is diversification. We're going to cover what it is, why we diversify, and then last, we're going to cover some very basic ideas, principles about how you can make sure you have a diversified portfolio and you are applying this principle in a good way for your situation. Little reminder, this is not investment advice. This is just some, what I want to do today is convey some principles and ideas to help you as you think about how to put together your investment strategy for your retirement or for whatever stage of life you might be in. So first, what is diversification? Simply put, diversification is owning more than one type of investment. A non-diversified, or sometimes what you'll hear when you listen to investment people, they'll talk about a concentrated investment portfolio would be owning just one, two, three, a handful of a single investment or a single type of investment. Where a diversified portfolio or a diversified investment strategy would be one where you own many different types of investments. So simply put, that is diversification, owning a lot of different types of investments. And I'll add one extra point, which is when it comes to diversification, it's more than just owning many investments. It's best done when you own investments that have a history of performing differently in different types of environments. The benefit of this is that when one investment is down in value, maybe another one of your investments is up in value, right? And this can provide a lot of benefits that I'm not going to go into today, but needless to say, diversification is owning a lot of different types of investments, and hopefully you own different types of investments or assets that have different characteristics and can perform and do well in different economic environments. This leads us to why. Why do we diversify? Why don't we just put all of our money in a single investment? Well, diversification is a tacit admission that we cannot tell the future. And so since we can't tell the future, we better spread out our bets, right? Because if you think about it, if we knew what was going to do the best, if we had the ability to just pick the best investment, why would you diversify? You wouldn't. You would just put all of your money in that one thing, right? And watch it, grow to the moon, right? So by diversifying, we're essentially saying, hey, we don't know, what's going to do well or, what the future has in store for us. So we are going to own a lot of different types of investments in order to spread out and spread out the risk, right? And so diversification, another way of saying why we do it is we do it to reduce risk. Diversification, I would say, is not the way to maximize returns. All the people that I know that have become extremely wealthy have done it by they've been business owners, or they've worked for a technology company that, through which they had stock options or other things. And these are all versions of having very concentrated wealth. So when it comes to diversification, it's about reducing risk since we can't predict the future. When it comes specifically to investing to save for a goal, be it retirement or saving for your kids' college or to leave a legacy to your family, reducing risk is this is the way that I think about it as an investment advisor and as a financial planner. What we're trying to do is we're trying to narrow the range of outcomes that you'll experience. So what do I mean by this? Well, let's take the example of somebody who, let's take a business owner. One business owner does extremely well, and their business grows and grows in value, and they become extremely wealthy. While on the other hand, you could have a business owner who loses everything and goes bankrupt. So by investing everything in a single company or a handful of companies, you have a very wide spectrum of outcomes: extreme success and complete financial ruin or failure, right? And so with diversification, we're really cutting off the extremes of both ends. Through diversification, we're never going to have extremely high investment returns. We probably won't. But we're also cutting off the downside of the extreme version of losing everything, right? So now we can narrow it down to, okay, if we use history as a guide, we can start to plan around a range of likely outcomes. Okay, so we can look at a portfolio, maybe you have a diversified portfolio of different types of companies in the stock market you're invested in. Maybe you own some real estate, maybe you own some, you have money in savings accounts, this sort of thing. So when you look at a portfolio of all these different types of investments, you can say, okay, over the long run, over 10, 20, 30 years, the range of potential returns that this portfolio has achieved is somewhere between, I'm just throwing out numbers here, is somewhere between 5 and 7% per year, for example. So now, with that narrow range of possible, or I should say of likely investment returns, you can now begin to plan. You can now begin to have some hard dollar numbers to help you know how much you need to be investing and for how long. So, for example, if you're saving for retirement and you have the goal of, saving a certain amount of money, and you know that, a range of returns that's possible is somewhere between 5 and 7% per year, now you can say, okay, if I want to have the amount of money that I want when I retire, that means I need to save at least, this amount per month, right? Without having that narrow range of possible investment returns over the long run, it's almost impossible to plan. You can't. So that's really the why behind diversification. It's about risk management. It's about cutting off the extremes of extreme success or complete failure. It's about narrowing the range of potential outcomes so that you can begin to just plan, right? Investing is a tool to help us accomplish something else, right? To purchase the thing we want to purchase, to retire with and have the lifestyle that we want, this sort of thing. Okay, so now let's get to some practical insights about, okay, how do you do this? I would say as an investor, this is the best time to be alive. There is so much variety and accessibility to different types of investments, and that comes with a lot of pros, and there's some potential downside, obviously. I'm going to use an analogy from a finance professor I took some classes from when I was in school, and you can find his stuff online. I think he's great, Dr. Craig Israelsen, and he has taught about investing using the analogy of making salsa. So bear with me. I think this will be helpful, so keep with me. When you're making salsa, you have different ingredients, right? Tomatoes, onions, cilantro, lime, salt, garlic, peppers, right? When you make salsa, you are combining these different ingredients. And depending on who you're making the salsa for, for yourself, or you're doing it for a party, or you're doing it for little kids, you might change the ratios of the different types of ingredients you're using. Maybe a little less peppers, or maybe a little more lime, or a little less garlic, depending on the preferences of who you're making the salsa for, right? Or your own, what you like yourself. And this is kind of how investing works. When it comes to investing, you are combining different types of asset classes, or I should say different categories of investments, and the ratio or the amount of each one of those investment categories is going to be driven by, what's going to be the guiding kind of the North Star or the guiding principle of the different ratio or combination of the different categories of investments. It's going to be the preferences, right? It's going to be, what are you investing for? Are you making salsa for little kids, or are you doing it for, watching the football game with your buddies, right? And so when it comes to investing, is this money for a purchase? Let's say you're saving it for the down payment of a house or something like that, and you need the money within 3 years, right? Or is this money for, you're leaving a legacy for your grandchildren, and you're probably never gonna touch this money, or it won't be used or touched for decades, right? You're probably going to use the same ingredients, but the ratios, the combination of how you put them together is going to be different based on the different situations. So with investment categories, we have things like investing in the stock market. You can do this very easily through diversified investment vehicles called mutual funds or exchange traded funds. Another ingredient investment category, a principal investment category, is investing in something called bonds, or if you watch other investment videos or podcasts or read literature on this, it's called fixed income. So this is another investment category. And there are so many varieties of stocks and fixed income or bonds that are available. I'm going to keep it really basic for this video. Another category is cash. And I love it because for so long, having your money in a money market account or something like this has been, you've been guaranteed your money, but you haven't really earned anything. So it's kind of a fun time where all of a sudden we can earn some interest by simply having our money in a bank account or in a short-term CD. So broadly speaking, these types of that category, we call it cash. So if you look at like an investment allocation chart or something, and there's, it says cash, that's what it's basically talking about. Either money market accounts or investing in very, very short-term government T-bills, right? 6-month T-bills or 6-month notes, right? So another investment category, for example, would be real estate, another separate category, right? And so a very easy way to do this, I'm going to talk about just some very, very simple ways. So let's say you're investing through your company 401k plan. Well, within that 401k plan, you're going to have access to things called target date funds. And frankly, by putting your money in a single target date fund, you're essentially buying, it's like going to the grocery store, going over to the deli and just buying some already prepared salsa. You don't have to think about, you don't have to go over to the produce and put everything together. It's already prepared. It's already mixed together. And essentially you can choose the target date fund that's going to align closely with your planned retirement date. This is a great and easy way to diversify. Another way that you can easily diversify is not having all of your money in a single place. So let's say you have some money invested in the stock market. Well, another thing you could do is invest in real estate, either through things called real estate investment trusts. These are things called REITs. You can do this very easily through ETFs, exchange traded funds and mutual funds, like I said. Also saving up and owning real estate directly. So these are a couple different ideas about how you can easily diversify. And I hope that this information can help you and guide you as you think about what diversification is, why it's important for your own situation, and how to apply it. So remember, again, this is not investment advice. This is just general investment information, principles about diversification, and I hope it's helpful for you as you try and navigate how to prepare yourself financially for retirement, maybe early retirement, or to accomplish the other things in your life that are important. Because ultimately, investing is all about putting our money towards things that are important to us. We don't invest just to invest. We invest for other, more important things in our lives. So I hope this has been helpful again, and I wish you the best, and I'll see you again soon.